One of the great surprises of 2023 was that there was no US recession. The US recession was the most popular forecast of the year. And a year ago, the Federal Reserve, for example, thought that growth this year would be less than 1%. In fact, what actually happened is growth was around about 2.3% in terms of GDP growth. Now, why was the US economy so strong? The US economy was so strong because of Bidenomics. And Bidenomics meant that the US economy was running a big deficit this year. 8.35% of US GDP is the budget deficit this year. And that budget deficit is going to continue. Next year, it's expected to be 7.4%. The year after that, 7.4%. 7% the year after that. And then 6.7 and 7%. So very strong budget deficits generating stronger than anticipated growth in the US economy for the next 5 years. Why is that happening? That's happening because of Bidenomics. There are a number of programs that Biden has made happen. Firstly, there was the CHIPS Act. We know that the biggest producer of chips, computer chips in the world right now is Taiwan, and that's under threat from being taken over by China. So the US is attempting to rebuild its domestic chips production. So the CHIPS Act has really big write-offs for US corporations investing in domestic computer chip production. That's generating those write-offs generate a big deficit. And in addition to that, we have the Inflation Reduction Act, which is really the Green New Deal, and that provides enormous subsidies for domestic manufacturers of electric cars and a lot of rewiring of the whole US economy, in fact. Now, you would think that would make Joe Biden popular. But amazingly, in spite of low unemployment and stronger growth, what's actually happened is that his popularity is falling. Now, why is that happening? Well, to understand why, we go back to that great theoretician of economics, Maynard Keynes, and a book by Maynard Keynes called General Theory. And in General Theory, which was published way back in 1935 during the Depression, Maynard Keynes had the problem that unemployment was very high because of deflation. Prices had fallen, and as a result of that, real wages had risen and priced people out of jobs. So what Maynard Keynes suggested is that governments run big budget deficits, and that would increase the price level and reduce real wages, and that would price people into jobs. Now, remember, what's important about that is that increasing budget deficits reduce real wages. They reduce the average living standard in order to price people into jobs. So that is what is actually happening in the US economy right now. Unemployment may be low. It's 3.8%, and it's up from about 3.6% earlier in the year. And that's low unemployment, but the problem is that real wages are low, and that's why Bidenomics is unpopular. And that leaves then the US with the problem still of those budget deficits and what that is doing to the level of debt. Because what's really interesting when we look at a chart of the level of debt relative to GDP in the US, that it has been rising. Not just recently, but it has been rising all century. And back at the beginning of the century, it was a bit over 30% of GDP. And now in 2019, it was 83% of GDP. And then in 2023, it's risen to 96.68% of GDP. And by 2028, the International Monetary Fund expects that US debt will be 112% of GDP. Now, the problem with that, with a budget deficits and of 7 to 8%, and with debt to GDP of 96 to 111%, is that means that interest rates have to be higher to keep financing that level of debt. And in our model of debt, of US debt, particularly US long-term debt, the major factors are that what the Fed is doing and how big the budget deficit is, and where interest rates in funding countries such as Europe will be. So what it means that the more debt, the higher interest rates that Americans have to pay relative to foreign interest rates to keep that debt financed. And that means that for Americans, interest rates are going to be higher than they anticipate for longer than they anticipate, because that debt is rising. What does that mean for the rest of the world? Well, Australia, fortunately, is in a position where our debt to GDP is nothing like that of the US. In 2023, when the US had a budget, had debt to GDP of 96% of GDP, our debt was 29% of GDP compared to Australian GDP. And in 2028, when the US is expected to have debt to GDP of 111% of GDP, our debt to GDP is expected to be just a little bit lower than 34% of GDP. So we don't have those kind of problems that the US has, fortunately. So that means that maybe our interest rates will continue to be just a touch lower than the US, right through to the end of the decade. But what we can anticipate is what usually happens in this case, where you've got really big debtor countries, is that when their economies slow down, and finally the US economy should slow down to about 1% growth next year, should be between 0.8% and 1% growth next year. What that means, investment in the US will slow, and the demand for money flowing in will slow, and the US dollar will fall. And a lot of that, and part of that reason for the US dollar falling is to make it easier for the US to fund all of that debt. What's happened in previous occasions, for example, in the British after World War II, or the Americans in the 1970s, is when this has happened before, there's a lot of capital outflow as foreign countries buy that debt as the US dollar falls. But we would expect the US dollar to fall in the second half of next year, and that there'll be an outflow of liquidity into the rest of the world next year, and that will generate a recovery, particularly in commodity prices, as we go through the end of 24, 25 and 2026. So it will still be tough for the US to finance its deficit, but that all that liquidity flowing out into the rest of the world could generate a lot more prosperity for countries like Australia and other countries in the Western Pacific.